Hello everyone, it's Paul Tilley. Welcome to PR2170 Project Management, and today we're looking at Unit 4, Managing Project Time, Cost, and Quality. This is video 2, where we'll be looking at Project Cost Management. The material in this unit is covered in chapters 5, 6, and 8 of the textbook. Cost management is really a process of estimating, allocating, and then controlling project costs. So the cost management process really allows the business to predict what the expenses are going to be and reduce the chances of overruns or potential problems resulting from overspending. Projected costs are calculated during the planning phase of the project, and they must be approved before the work begins. Again, someone's responsible for how much this project is going to cost. As the project plan is executed, the expenses are documented and tracked, so that we kind of have an ongoing evaluation of looking at the costs and saying, is this meeting what the expectations are? And we're constantly checking to make sure that the cost matches what the budget has been approved for. So this allows us to provide benchmarks for future cost management plans and future projects. So what we're looking at is really 4 primary phases of this cost management process. The first phase deals with the planning stage. We're looking at resource planning. We're thinking about how much is this potential project going to cost before we ever start it. And then we're going to say, okay, what are the cost estimates? Let's get a finer estimate. And we look at several processes where we look at even finer estimates of costing. Then we develop a budget. This is how much we're going to spend on this, how much we're going to spend on that, how much we're going to spend on something else. Then we actually have the construction of the project, and we do what's called cost control during that phase, where we evaluate to ensure that we are on budget, on time, and that we're not exceeding the parameters that were set out in the cost budgeting process. And if we are exceeding those parameters, we need to make plans to deal with it so that we can minimize the overage. Looking more closely at resource planning, this initial stage has us identify the resources that are required to actually make the project happen. Okay? Examples of resources are people, such as employees, contractors, labor, these sorts of things. Equipment, such as infrastructure, large construction vehicles, specialized equipment, the materials that are used in the project, these sorts of things. So resource planning is really done at the beginning of a project before a shovel hits the ground or before anyone writes a line of code. It really needs to be done up front so we have a good idea of what we want and what it's going to cost to achieve what we want. Next, in the second stage, we're looking at cost estimation. Cost estimation is really a process of qualifying the costs associated with the resources required to do the project. So we've determined the resources. Now we got to look at what are the costs of those resources. So to perform cost calculations, we need the following basic information. The resource requirements, which we've covered. The price of those resources, such as the staffing costs for hours, vendor hiring costs, procurement costs, material rates, and so on. Duration of each resource and how long it's going to be required in order to do what needs to be done. How long do we bring in that crane for? How long do we need that program developer for? A list of assumptions are required. Potential risks need to be identified so that we can come up with some management plans for those risks. Past project costs and industry benchmarks are often looked at. So did we have a similar project before? What were the costs of that? What were some of the issues we had there? Or are there other industry standards, like how much it costs to build a building per square foot? And we need some insight into the company's financial health to make sure that we can actually afford the project to move it forward. The third stage grows immediately out of the second stage, and that is the cost budgeting. So we've got our estimates, so now we kind of need to put a finer point on those estimates by creating some budgets. And the budget is a planned expenditure, really. So it can be viewed really as part of the estimation or a separate process. And what we need to do is allocate the cost for each individual chunk of project. So for example, if the project has 10 phases or 10 parts to it, what is the cost of part 1? What is the cost of part 2? And so on. So this breaking it down into the tasks allows us to get a better handle on the exact cost of each of those tasks and then build up in order to get a total price or a total budget for the project. Budgets usually include some sort of a contingency reserve, which is an allocated amount of funds for potential overages or change orders or these sorts of things. So it normally comes in as a percentage of the total cost of the project. The final stage is different than all the rest because what the first three did was really the planning stage. When we actually start construction or start to build or start the development of something, then we have to concern ourselves with cost control. So cost control really occurs during the process of the project. And what we're trying to do there is to say, okay, let's look at our actual costs and let's compare our actual costs to what we had budgeted. So if we budgeted $100,000 for something and we find that it's costing $80,000, that's good, meaning that the budget was $20,000 over what we actually spent. That's a good thing. However, if we budget $100,000 and we're spending $150,000, that's not so good. That's an overage. So what we're looking for when we do this cost control is to look for overages and to identify why those overages are happening. So cost control is really a continuous process done throughout the project, throughout the life cycle of the thing. And really the emphasis here is really to make timely and clear reporting and measuring and changes if required. So along with the cost baseline, the cost management plan is really essential for cost control. The plan contains details such as how project performance will be measured, what's the threshold of deviations, once it goes over 5%, for example, do we make changes? What actions will be done if the threshold is breached? What changes would be required? Do we cancel it? Do we do something else like that? And we kind of list the people and roles that have authority to make those decisions. So all that stuff needs to be done in the cost control phase. Our experience in the world of projects has shown that costs can really get out of control really fast. And this can cause some real problems. I hold up Muskrat Falls as an example. The original cost was $6 billion. It came in over 12. So this is a real challenge for people who have to finance these projects. If you think that it's going to cost 6 and it ends up costing 12, that's a real problem, and it could seriously impact the viability of the company or the organization after the fact. So we really need to keep a real tight management on control. We got to be realistic too on the front end when we actually do those first 3 stages to make sure that our budget is close to what the actual costs are going to be. Because we're fooling ourselves if our budget is constantly lower than what our actual costs are. So we need to be very, very careful with cost budgeting and cost management to ensure that we get a successful project, successful outcome that actually benefits the organization involved. So as a project manager, one of the key roles of a project manager is to ensure that the costs are well managed. And the principles that we're talking about here will help us do that. So they must, as a manager, you got to make sure that projects are very clearly defined, the schedule is accurate, the cost estimates are accurate, and that the budget is realistic to ensure that the costs can be managed and the project comes in on budget and everybody gets what they're expecting. Next, we're going to talk about the processes that are involved in cost budgeting. Before we actually begin that, though, we really need to look at some of the terminology. First, we look at profits. Profits are really a simple calculation. You take your revenue and you subtract your expenses. That gives you your profit. To increase profits, really, a company needs to either increase its revenue or decrease its expenses, or try to do both. Most executives are really concerned with profits more than any other issue. So when justifying investment, a new information system or a new technology, it's important to focus on the impact on profits, not just revenues and expenses. Further on profits, we can look at the concept of profit margin. Now, profit margin really looks at a ratio between how much profit we bring in versus how much revenue we bring in. So if you have a high profit relative to the revenue, that means you're making a very good profit margin. And most organizations would certainly like a higher profit margin than a lower profit margin. And projects that have a high profit margin are certainly ones that are more attractive to companies. We also have a concept that you're probably not familiar with. It's called life cycle costing. Let's say, for example, you buy a car. The car costs $30,000. That's the cost to purchase it. But think about over its life now. You're going to put tanks and tanks of gas in it. You're going to buy insurance for it. You're going to have to fix it. You're going to have to do a bunch of things. those are all the costs of really making that car do what you want it to do. And that's what we consider when we look at cost life cycle. We're saying to ourselves, okay, we got the initial purchase cost, but we also have all the costs of making it do what it needs to do. So life cycle costing really looks at the big picture of cost and over the useful life of the item. And that way we can get a better sense of how valuable is this to the company. It's one thing to think about cost, but it's totally another to think about how that cost flows when you actually have to pay the bills or actually have to spend the money. So cash flow analysis looks at the actual flow of money, and it really determines the annual costs and the annual benefits of owning or operating or building something. So we like to have a project that pays what's called a positive cash flow, meaning that there's more money coming in from the project than what we're actually spending on it. So cash flow is often looked at from a positive point of view. We need to have a positive cash flow in order to ensure that the project will move forward and is viable. Another important term is the concept of tangibility of cost. Tangible costs are costs that can be easily identified. You can easily put a price tag on something. So that car that you bought, $30,000, that's a tangible cost. Intangible costs, however, are costs that are very hard to measure. And they could be costs or they could be benefits. But things like goodwill, prestige, improved productivity, it's hard to measure those. They don't really have something you can look at and see a price tag attached to it. And it's very hard to qualify them. So if we have a benefit that comes from something because we've invested in it, if there's no real cost or no real revenue applied to it, it's hard to be able to put it on a sheet of paper and say to someone, this is doing good for us. We also have to make a distinction between the concept of direct cost versus indirect cost. Direct costs, like tangible costs, are very clearly defined. It's a direct, attributable to something. This is where the money came from. This is where the money is going. It's very direct. We can see it. We can say, this is where the money went. This is where the revenue came from. Indirect costs or indirect revenues are not really directly related to the products or services that we sell, but have some expense. So office staff, for example, don't really produce product, but the office staff are very important to make sure that the company works. So the cost of running an office is very much an indirect cost to the cost of production. Next, another concept that you probably never heard tell of, something called sunk costs. Now, sunk costs are kind of odd because these are costs, true costs, that have happened in the past, okay? You bought a car and there was a cost to it, but let's assume that car was a real lemon. It was a dud. And you're thinking to yourself, in order to make that car worth anything, I got to put a lot more money into it in order to sell it. And you're thinking to yourself, is that a good idea? Well, in business school, one of the things that we learn about is the idea of the fact that we shouldn't make decisions in the future based on decisions we've made in the past. So if we've made a silly decision by buying a junker in the past and we spend a pile of money on it, putting more money into it is not really a good rationale. So we use the term sunk cost to define costs that have already gone by, and they should not be used as a basis for making decisions in the future. Another interesting concept that is brought forward here is the concept of learning curve theory. In learning curve theory, we're all familiar with this, but we're probably not familiar with the terminology. Think about something that you learned. You learned to ride a bike, you learned to knit a sweater, you learned to write some code. Just think the very first time you did whatever you did. It took you a long time to do it. It took you a long time to learn the bike. It took you a long time to write some code. It took you a long time to knit a sweater. As you became more practiced at it, what took you long to do no longer takes you as long. In other words, you've become better at it. You've gotten better at doing the task. So that means the actual cost of doing the task in terms of time has dropped. And that's effectively what learning curve is all about. As we get better at something, the cost per unit will drop because we get better at making each individual unit. So if we've got a project that's a one-of, it will take us a certain length of time to do. If we do 6 or 7 projects that are very similar, I'm sure that we can bring down the costs of it. Next, we talk about the concept of reserves. And reserves are really stashes of money or stashes of budget that are put aside to account for overages. Okay? We talk about different kinds of reserves. Really, there's two basic ones: contingency reserves and management reserves. Contingency reserves really allow for future situations that may be partially planned for, but didn't really show up in the plan. Okay, so we needed to add an extra set of steps that no one thought about. Usually, for example, a building, a contingency reserve will be in place to pay for things like that, so we don't end up going over budget. So usually it's a percentage of the total project cost. So the good thing about these contingency reserves is that they're pretty well predictable, and we know that they're probably going to come up. It's reasonable to estimate them. Management reserves, on the other hand, are unknown reserves. We don't know that this is going to happen. I suppose you could consider that it may happen, but it's not planned for. And whenever we run into a situation where we need to draw down extra money or we're gone over budget, a management reserve is in place strictly to say, we need to get authorization. We need to go to the board. We need to go through a lot of steps in order to be able to spend this extra money. And it is not easy to pry money out of a management reserve, nor should it be, because what it does is more or less just an emergency situation pops up. We need to fulfill that emergency. So in terms of planning cost management, the first step we really need to do is to plan how the costs will be managed through the life of the project. So project costs, like project schedules, grow out of the basic document that initiated the project, like a project charter. So it is when the company says, yeah, let's move ahead with this project. The project manager and other stakeholders use expert judgment, data analysis, past experience, and meetings really to produce a cost management plan. The cost management plan, like the scope and schedule management plans, can be informed and really be a formal, detailed, and based on the needs of the project. So we really think about the cost management plan, and we need to think about the variables in it. First, we got to think about the level of accuracy. Activity cost estimates normally have rounding guidelines, such as to the nearest $100. May also be guidelines with regards to contingency funds, no more than 10%, for example. The units of measure. Each unit needs to be some way costed. How are we going to measure that? How are we measuring labor costs, for example, or labor hours? What about the organizational procedures? Many organizations refer to the work breakdown structure component used in project cost accounting as a control account. Each control account is often assigned a unique code, so we can allocate costs to it. Some project teams really must understand the codes in order to be able to allocate those costs. We also have control thresholds, which is similar to variance in schedules, and really what we're trying to do is check the variance on the cost. So if it's allocated $10,000, how much cost is actually spent? And it really shouldn't be any more than a percentage over the basic baseline cost. We also have rules of performance measurement. So if a project uses an evaluation system called the earned value analysis, and we're going to describe it later on, the cost management plan will define measurement rules, such as how often we actually measure the cost, how we track them, what level of detail is required. We need to consider report formats. What's the reports going to look like? For example, the variance reports. How are they going to show up to people? How are we going to get them out? How often are we going to get them out? And we need process descriptions, which is really a cost management plan that will describe how to perform all the cost management practices, a clear understanding of what needs to happen. In terms of estimating costs, now that we have documented the project resource requirements, so you're ready to really begin the cost estimating process. And in order to do cost estimating, you need to think about developing a project budget to do that. So how much are certain parts of the project going to cost? So cost estimating is really approximate, but the idea is that the approximation needs to be as close to reality as possible, and that's our goal. So you really have no way of knowing how much the project's going to cost, but you can pretty well guess within reason using all the bases that we talked about in terms of expert opinion and the like. We try to increase the precision as close as possible, and really that is going to flow into something called a cost management plan, which is really a document that describes how the organization is going to manage the cost variances if they happen. And the cost management plan really describes how to respond to proposals that are higher or lower than the estimates. There are several types of cost estimates, and each one of them is more refined. The first one, the broadest one, is rough order of magnitude, and it is really a rough measurement. It is really a ballpark estimate, a guesstimate, and this type of estimate is done very early in the project, to give an idea the project is going to cost $100,000, for example. And project managers and top management use the estimate to help make the project selection decisions. So, for example, if you have 6 projects to choose from, the rough order of magnitude is really good for saying, which one do you think we should pick? We can't do them all, right? So you can think of rough order of magnitude not being very accurate. It could be anywhere from 50% lower, than the actual cost, or 100% higher actual costs. So it's a bit of a concern in terms of running the project, but it is a very good, useful tool in terms of deciding which project you should choose. A finer measure is a budget estimate, and we effectively use our tools that we've talked about so far in terms of the work breakdown and the structure and the like in order to help do that. So many organizations develop budgets, really kind of stretch out into the future 2-3 years. So budgetary estimates are made 1 or 2 years prior to project completion. The accuracy of the budget estimates is typically somewhere between -10% and 25% above. So somewhere in terms of pretty close to cost accurate. And you think maybe you can have cost run, the actual cost will be 25% more than what you predicted. Cost budgeting is really that process that allows us to get all of this basic groundwork done. And it's very important. And as I say, it builds off the work breakdown structure, because what we can do is develop a cost estimate for each individual component, and that will allow us to get a more realistic view of the total cost of the project when we add it all up. Finally, we have a definitive estimate. This is the most accurate form of estimate. And definitive estimates are used in making many purchasing decisions for which accurate estimates are required, or for estimating final project cost. And definitive estimates are made 1 year or less, pretty close to the actual time. And they can give you a really good handle on what, the cost in the definitive estimate that it predicts should be very close to the actual cost of the project, usually between -5% and +10%. So we got lots of tools there, and there are lots of techniques that are used in order to kind of facilitate this estimating. And I'll just show you a few of them. We have something called analogous estimates. And analogous estimates are exactly that. They look at other projects, for example, project A, B, C, D, and they say, okay, which of those projects were closest to the project we're about to start? And let's say project C was the closest one to the project we're going to start. We look at what was the cost of project C. These are completed. A, B, and C, and D are already completed. So it's closest to the project we're about to start. So if it cost us that much to do the one that we just did, project C, for example, we can pretty well estimate that our new project will cost about the same, plus or minus a percentage. Next, we have bottom-up estimates. And this is what I was just referring to in terms of the work breakdown structure. Bottom-up really takes the project, divides it into little tiny parts, and it does estimated costs on each of the little tiny parts. The total project is the sum of all its parts, and the total cost is the sum of all the costs of those parts. Finally, we have something called parametric modeling. When we think about parametric modeling, what we're doing there is using mathematical models, and this has become very popular, particularly in terms of software design, where we say, okay, look, if we look at similar projects in the past and we break them down into their units, so instead of looking at the project as a whole, we're looking at the project units, okay? And we kind of say, well, this project that we're doing here now has this unit, and that unit. So we pull out the units and we estimate our project, our current project that we're going to move forward on, based on the unit costs of previous projects. So it is looking backwards at previous projects, but instead of looking at them on a holistic level, we look at them on an individual level. Some typical problems with costs, well, particularly in IT projects, estimates are done too quickly. You know, we don't do a good job at estimating, and you see it's a pretty intricate process in order to be able to get these estimates. People lack estimating experience, and again, it is a profession in and of itself to be able to estimate projects. Human beings are biased towards underestimating. Think of your last project where you built something. I bet you darn that it came in at least 50% more than what you thought, because we're naturally inclined to underestimate something in order to get us to go ahead. So controlling costs is ultimately the goal of all of this whole project. We need to be able to take our costs and manage them through the life. In order to do that, we got to monitor performance constantly. We look at all of the tools that we've talked about here. We create reports. We look at work performance information. We make sure there are proper approvals in place. We use the various tools that we talked about. And we use general accounting principles in order to really assess how costing should be allocated. One of the more interesting and complicated but more defined tools that have been used as of the last number of years is something called earned value management. Now, earned value management is a more intricate process, usually uses some sort of a mathematical modeling again, but the basic core of it is simple. Effectively, what we do is as a project is moving along, okay, this is a control phase type situation that we're looking at. As the project is moving along, we're constantly monitoring things like the cost, the project schedule, and information with regards to how the project is moving in terms of relative to the budget, relative to the plan. So earned value management assesses the idea of, is it living up to the plan? If the plan says we're supposed to be this far in 6 months, are we this far in 6 months? If the plan says that it will cost $1 million in 6 months, are we spending $1 million in 6 months? So I need you to take a look at the videos there in order to really get a handle on the detail of earned value management. But from an overview point of view, what we're doing is we're checking as we go along. And this is a tool that is very, very useful in terms of the overall analysis. And we talk about some of the terminologies there, such as cost variance, schedule variance, cost performance index, schedule performance index. Again, the two basic criteria that are being evaluated there is the schedule and the cost budget. I invite you to review the questions at the end and look at the discussion problem. And if you have any questions, you let me know. Thank you.